Welcome to the Conch Economist. I'm Merle Dimbath, and I'll be sharing with you insights and explanations about current economic issues and problems. I want to help you become your own economist. Our goal is to survive the waves of economic change by making better decisions and choices in the ordinary business of life.
Every newscast today seems to be talking about interest rates, particularly if it's a business newscast. Not surprising, the Fed meets again in 2 weeks to make another decision on interest rates, and there's a lot of speculation and hope that rates will be lowered. It's important to take a moment to remember just how important interest rates are in our economy. They're fundamental in our market economy. They influence a broad range of investment decisions, which is basically how we allocate scarce resources among competing ends. Interest rates are significant in consumer choices of housing and cars to buy and other durable goods. Major goods and services such as vacations or medical care can be influenced by interest rates. Interest rates influence exchange rates of the dollar, and if you're going to be traveling, the interest rate that we get domestically as well as in foreign countries influences the exchange rate. So investments are very much geared toward the rates of interest, and our whole way of life is too. It's important to keep in mind that there is an inverse relationship between interest rates and the price of a bond or the value of any asset. And we see this playing out in the prices of gold, silver, real estate, and so forth. That as interest rates go up, there is a corresponding decline in the present value of many of these assets. Let's take a moment to review just why is there this inverse relationship between the rate of interest or the rate of return and the market value of an asset such as bonds. We'll use a very simple example here. Let's assume that we're going to have an investment that'll be worth $100 in the future. Well, what's its worth now? And that worth now is sometimes referred to as present value. It's really going to depend upon the time of the wait between now and the future and the prevailing rate of interest. And the interest rate can vary depending upon the risk factors. For example, U.S. government securities are considered to be low risk, and so you would expect them to have a lower rate of interest. An unsecured loan to a person would be a higher risk and would therefore be expected to have a higher rate of interest. So the interest rate is a function of the creditworthiness of the person making the loan or borrowing the money, I should say. Let's assume, for example, $100 a year from now, and if the rate is 4%, the indicated value, assuming low or no risk, $96.15. Now, what that means is that if you had $96.15 today, invested it at 4%, a year from now, it would be $100. However, if the rate is going to be 3%, then we can see that the value is $97.08. Now, why is that? Well, because with a lower rate of interest, if you are wanting $100 a year from now, you're going to have to invest more today. So we can see here this inverse relationship over a 1 year period of time, 4% versus 3%. A 4% rate of interest, you would invest a lower amount, $96.15, or its present value would be worth $96.15. But if rates fall, the value of that asset would go up, or you would have to pay $97.08. Time is a factor also. Let's look at the same 4% 2 years out, $92.46. Now, $92.46 invested today at 4% in 2 years would be worth $100. And again, there's the inverse relationship between interest rate and present value or worth today. 3%, $94.26, which means that $94.26 invested today at 3%, and this assumes annual compounding, would be worth. So we have a little arithmetic example here of why there is this inverse relationship. which means that if the Federal Reserve 2 weeks from now lowers interest rates again, we might see certain assets go up in value. For example, very often investments like gold can be sensitive to interest rates. Gold doesn't pay a dividend, and so if you're going to buy gold, you're having to give up interest, at least an interest rate of return. You hope that maybe gold goes up over a period of time so you get capital gains. But since gold doesn't pay any interest, um, you're surrendering less interest at lower rates of interest rate than it would be at a higher rate. And so very often you will see an inverse relationship manifested in gold or platinum or silver. Even cryptocurrencies can be influenced by interest rates. Well, let's take a look and see what is the current structure of the yield curve, as it's sometimes described when we look at the rates of return over a period of time. And we're looking here now from the most recent release from the Federal Reserve System, dated November 25th. And currently, the target rate for federal funds is between 3.75 and 4%. Now, the Fed accomplishes this by changing its discount rate, which is currently 4%. This is the rate that the Fed charges banks when banks borrow from the Federal Reserve. Federal funds is what banks charge each other when they borrow from each other. And the Fed is accomplishing its goal of a range of 3.75 to 4%. The federal funds rate is now, and has been for some time now, for several days, weeks, I should say, 3.88%. It's interesting when we look at the yield curve, and in the short period of time here, a 1 month rate of return on a U.S. government bond is right at 4%, 4.02%, which is kind of in line with the goal of the Federal Reserve for short-term interest rates. Bear in mind that all the Federal Reserve can really do is influence short-term interest rate with its federal funds policy. Now, by buying and selling various durations of bonds, they can influence the longer bonds. But for example, we can see here the 3-month bond is 3.94, 6-month 3.79, even 1 year 3.67. We might wonder why that is. Well, market forces begin to become influential over a period of time. For example, even out to a 5-year bond is 3.7%, 7-year bond 3.89. This is below the discount rate of 4% of the Fed, and which means that market forces are at play here. Yes, the Fed has powerful influence, but so do the market forces. Now, when I'm talking about market forces, I'm talking about the overall demand and supply of loanable funds. Interest rates are a price. They are the price for borrowed money, whether you're borrowing money to carry a balance on your on your credit card, or you're borrowing money to finance your car, or you're borrowing money to finance your house, or businesses are borrowing money to finance inventory or equipment or new buildings. The interest rate is a price. And over a period of time here, this price does vary depending upon the supply and demand for loanable funds. We don't begin to get a yield beyond 4% until we get closer to 10-year, which is currently 4.12%. The 10-year bond is crucial because it is influential in the mortgage market. The 30-year bond now is up to 4.74%. That's the long range. It is interesting to note that as we go from 10-year to 20-year to 30-year, interest rates do climb. Now, there has been a proposal recently to have a 50-year mortgage bond, or a mortgage rate, or a mortgage loan, I guess I should say. Now, if the 30-year bond is yielding more than the 20-year bond, wouldn't you think that a 50-year mortgage would carry a higher interest rate than a 30-year mortgage? Probably so. The bank prime rate of 7%, this is the bank rate that banks charge their biggest and best customers. If you are, General Motors or NVIDIA, and you are borrowing from the bank, you'll get the bank's best rate of 7%. So when the Fed meets in 2 weeks, the expectation is that maybe the federal funds target will be lowered from the current 3.75 to 4 to maybe 3.5 to 3.75. They would accomplish this by probably lowering the discount rate by a quarter of a point down to, say, 3.75. To take advantage of interest rate returns that are available on U.S. government securities, as well as other types of bonds, there are investment instruments called exchange traded funds. This is an investment fund that holds a variety of assets, such as stocks or bonds, treasury bills, commodities, other things of value, even cryptocurrencies are in various types of exchange traded funds. These funds, like a stock, can be bought or sold on an exchange. Now, it's not my recommendation that you do this. I'm not in the business of giving financial advice, but I can tell you what I have done, and I have from time to time purchased exchange traded funds, and there's a variety of them, and I'll share some of these with you. There are dozens of, probably hundreds of exchange traded funds. I'm going to give just a handful just to give you an idea of what's out there. There are many different ETFs or exchange traded funds, and they are composed of government and non-government interest earning assets. There can be ETFs that have strictly corporate bonds. The ones that I've got here on the screen are by and large ETFs based upon treasury. When they go to cash, they usually buy treasury bills, and they can buy them here through BIL or T-bill. Or you can buy them direct from the Treasury. I don't have a screen display for this right now, but I have purchased directly from the Treasury short-term securities bills. You can do this. Go to U.S. Treasury Direct. It's not hard to do. You set up an account and you can buy Treasury bills and lock in a yield for 12 months or 18 months, 24 months, whatever you want. The bill and the T-bill have the advantage of being, you can trade them daily. And it's interesting to look at the different rates of return here. The 20-year Treasury bond is, the TLT currently is yielding about 4.29%. We saw this in the earlier diagram that at the very short term here, there's 4%, but after we get to a longer period of time, interest rates do go up. You may remember that in the near term, some of the rates were actually lower, and we can see here on an ETF that goes for 7 to 10 year Treasury bond and indexed 3.71%. I indicated earlier that there was a relationship between interest rates and the dollar. I've got some screen displays here, which I'll present, showing the U.S. dollar index, UUP, and it's an exchange traded fund, and it tracks the U.S. dollar exchange rate, and it currently is yielding about 4.65%. The Treasury also issues securities that are inflation protected. They're called TIPS. It's an acronym for Treasury Inflation Protected Security. And there's ETFs that you can purchase for this purpose. They're yielding 3.13%. Now, it's lower than the other rates, but bear in mind this is an inflation protected rate of return.
Well, this concludes my report to you for now. Please share this with others and don't forget to subscribe. Join the Conch Economist next time for more Surviving the Waves of Economic Change.